Good afternoon, everybody. Welcome back to my channel. It is me, Kadero Hudson, the Millennial Investor 1914. Holla at your boy. This is my last video for today that I'm going to record, that I'm going to chop it up, record, and deliver it to the public like I'm Lucas or something, Yeah, that went over your head. Anyway, today's video, we're going to talk about how to invest. So this video, if you are in the investor community, then you probably already know about these ETFs. So hey, if it doesn't fly, you know what I'm saying? If you don't buy, let it fly. But for individuals who this video is going to be for individuals that you just starting out, you don't know where to start. A lot of times, a lot of individuals don't start investing because they're like, man, where do I start? What to buy? I want something simple. I want something easy. I don't want to do all the math. I just want something that I can just open up an account. I can just buy it, and I can just put money into it on a per monthly basis. I have a lot of friends and family that outside of their 401k, they're just like, man, I don't know what to buy. We're gonna talk about it. We're gonna get right into it. We're not gonna no fluff. The first ETF is the iShares US Technology ETF. Ticket symbol is IYW. So it's the IYW, it's the iShares US Technology ETF. You're going to utilize this ETF because you want to grow your portfolio. So you're gonna this is more going to be so a niche. I typically preach about core in the satellite method. This is going to be more so of your satellite type of stock or ETF. Has an expense ratio of 0.40. It's pretty high. Year to date, it is up 8.85%. Now, one year tend to produce 46%, which is good. 15% for 3 years, 23 for 5, 10 years, and so this ETF produces a lot of high rate of return. The top 10 stock holdings has 18% in Microsoft, 15% in Apple, 12% in Nvidia. So right there, with the first three, with these weights being so high, you see why. And so I used to have this in my Roth, but I sold it, and I just wanted to focus more so on QQQ. We'll talk about that later. But yeah, you see right here the remaining holdings in this ETF, the top 10 is Meta, Google, Broadcom, another Google, Salesforce, Adobe, AMD. This ETF has a mixture of it's high in technology, but it has a mixture of like semiconductors. So like what you see right here, you'll see a lot of AMD, KLAC, Nvidia. But you'll see a lot of other tech stocks as well, like Microsoft, Apple, um, Intel, which is semiconductor stocks, and other as well. So keep in mind, if you want something that's going to grow your money that you don't have to worry about, IYW. Next, again with the core and the satellite method, VU or VTI. Everybody in the investing community know about it. Everybody makes a ton of videos, but this goes out for individuals that typically, honestly, know that don't know how to invest. So for individuals that already know how to invest, you already know and familiar about VU, you can skip over this. And I'm gonna have things at the bottom just to show different episodes or whatnot. And you can just skip over this content for right now for VU. VU is the SP 500. SP 500 is the top 500 companies in the United States, and typically these stocks are pretty consistent in every ETF that we're going to go through when I go through the holdings. The cost of VU SP 500 is $478. I actually bought some VU today in my Roth RA. And when we go right here, year to date has, as right now, year to date is up 9.76% year to date. Typically, the performance is 9 to 10% for the year, and we at half the year, and the ETF is up 9% already. It's up, and so right here, boom, 1 year 22%, 3-year 8%, 13%, 10-year 12%. Since inception, has high 14%. We've had a lot of high years of just high rate of returns from VU. It's actually a pretty smooth ETF. And VU, remember in XY right here in this ETF, the XYW, the percentage in Apple, Microsoft, and Nvidia was pretty high. It was like 18%. So that's why it produces, it's very volatile. And here, not so much. You're still getting more bang for your buck by 7% being Microsoft growth company, 5% in Apple, Nvidia. So you're still getting that more bang for your buck from the IT sector. But at the same time, when you scroll down, the more value plays of Berkshire Hathaway, Eli Lilly, Broadcom is an IT company. It's a little bit more diverse. It's 500 companies, so it's spread up into 500 companies. And yeah, it's still top heavy with the tech companies, but it's still a little spread out compared to the IYW. Typically, people buy VU or VU right here, VTI. I'm gonna scroll up so you guys are familiar. If you're a new investor, typically people buy this and they don't buy anything else. Typically, if you want an ETF that basically you just want to just buy and you just don't have to worry about it, you don't want to worry about buying stocks or whatnot, different ETFs, you just one ETF, and you just want to walk away. People typically buy VU or VTI, and then they just put 500, 1,000. That's what I'm doing. I'm going to be putting $500 into VU per month. I'm gonna buy, my satellite stocks, Microsoft, AMD, regional financials, etc., etc. But VU is going to be my core holding, and my Roth IRA, VU is my core holding, and another portfolio, VTI, is my core holding. Right. Another ETF that I want to go through is that people may be familiar with, but people may not be familiar with, is VT, the total world stock market. And this ETF, I say that I wouldn't suggest this just as a standalone ETF like VU or VTI. I would use this as more so a satellite type of thing. So what you keep hearing is you'll keep hearing core or satellite. This is more of a satellite. This gives you exposure to not only U.S. stocks, but stocks outside of the U.S. Like, for example, Mitsubishi, which is Japan. What's another? Novo Nordisk, which is a healthcare company. ASML, which is a semiconductor company, and you get so. The reason why I wanted to include this is because when you talk to financial planners, financial advisors, they say that it's extremely risky to just only invest into the U.S. market. And you know how what they say. They said by us being Americans, we have a lot of hubris. We're very confident / cocky for us just to only just invest into our markets. And they have stats. They have stats and data to prove that in certain times when America was doing bad, in our when our American economy was doing bad, that the foreign economies of developed markets of Europe, Japan, Netherlands, Great Britain, etc., emerging markets in China, in India, etc., that when we had like a Great Depression, I think it was like 2008, or it was one of those where when we were doing bad, the emerging markets and the other markets, international markets, were doing well. And so that's why when you do the Bogle 3 portfolio, one is like VU VTI, one is like a bond fund, and one is like an international fund, typically. Right here, buying VT, you get your best of both worlds. You have percentage in American companies, percentage in foreign companies, all in one. And first off, it costs $110.39 right here. The returns is really I would only buy this just for the diversification, but I wouldn't put. I would just have this as like at my satellite, just to be highly diversify my complete portfolio. But I wouldn't put like huge stock because like look up the turn. 1 year 16%, blah. Year to date is 3.88%, blah. And then 3 years 3.88, blah. 5, 9. You see, it's like average returns. It would take your money a long time for your money to double. Think of the rule of 72. Take your money a lot to double. But what I do like about this fund is diversification. And so right here, of course, as we go through all the holdings, these holdings are typical. These are the holdings that are in the SP 500. That's doesn't change. But as you go down, now you start to see the international companies, the Taiwan Semiconductor. What else that I could point out for you guys? Oh, ASML. When I told you I was trying to pronounce it, that Novo Nordisk, and then I'm pretty sure if I would go to more so into this portfolio, it will be split out even more. Like Mitsubishi and Sony. I think Sony's a Japanese company too, I believe. Yeah. So this is the total world. So it has the United States and then all the other companies. And lastly, what I like to show you guys like the breakdown, which is what I think is cool. This is cool. So this is the exposure of VT. So it's 62% in the United States, 6.25 in Japan, 3.55 United Kingdom. You got Canada, you got France, China, India, Switzerland, Germany, Taiwan, Australia, Korea, Netherlands, Sweden, Denmark, Italy, Spain, Brazil, Hong Kong. And then as I scroll down, more. So as you go up, the more percentage of exposure. But that's what I like. That's what I personally like about this ETF. I wouldn't put so much stock into ETF, but if I had it like in a IRA, I would and use it as a bogle position. I would just have a small position, just so I would be completely uh, diversified, right? Next ETF, which I like that I invest into, QQQ. It's the top, right here. It's for individuals who are seeking exposure to the U.S. large cap growth stocks in the NASDAQ 100 index, which contains some of the world's most innovative companies. Why? So typically, this gives you right here what are the typical returns of the S&P 500, the Russell 1000, and this is the typical of the NASDAQ 100. And then if you go into product details, that's why I really wanted to show you guys why I invest into QQQ. Yes, look at this bad boy. Look at this performance. This performance, typically, the performance. Well, that's not gonna lie. That's pretty high. The 1 year is like 32%. This is what I want to show you guys. Typically, the 5 year, the average, the 32 is like unheard of. But that year, I believe the S&P 500 was at up 22%. But also the year prior, we were into like a little mini recession where we were down a lot. So if you were to invest if you were to continue to invest that year, the following year you would have been up a lot. Just FYI. But the 5 year average is 18%. The 10-year average is 18%. Keep it in mind in my calculation that I have later on to show you guys to compound your wealth. 18%. So do 70, rule of 72, do 72 divided by 18. You'll know how many doubling periods your money will have. Just keep that in mind. Lastly, the portfolio. So what's in QQQ? It's the same companies, the same OG, the same OG of Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom, and Google. So, but it just have higher rates in Microsoft, higher rates in Apple, NVIDIA is high. Everything else is in the tech space is blended. But a stock that you probably don't normally see has Costco, which is a high growth consumer staples company. Also, I typically use QQQ as a satellite, but you could also use QQQ as your core investment as well. It depends on how much risk you are willing to take. Another high growth ETF that people tend to use as a satellite investment is SCHG. SCHG costs $93.14, has an expense ratio of 0.04, which means that basically it doesn't cost a lot of money to own this. The performance of SCHG is 1 month is down a lot. Down a lot. 3 months, 4.7. Year to date is up 7%. 1 year up 35%. It's the growth. Those growth companies, those Googles, the Apples, and Nvidias, the tech. 3 years, 8.9. 5 years, 17.18. And just so you understand the portfolio, it's the same thing as the S&P 500. But you have Eli Lilly and Broadcom in the top 10. The last ETF that we're going to go over, I had it between, it was either going to be XLK, which is this, or VGT. A lot of people are familiar with VGT, so that's why I included XLK. All you need to know is that when someone is looking for a ETF, information technology ETF, especially people who are into tech and high growth, they're either going to choose for high returns, XLK or VGT. And honestly, it's just really your liking and your. And to be quite honest, VGT, the only really big difference between the two, XLK has higher returns, but the last 5 years, VGT has the lowest expense ratio. And the only reason why XLK has been high returns is because it leans heavy. Let me just show you real quick. So year to date, 2.16% is up 2.16%, which is not up by a lot at all compared to all the other ETFs that we showed you. 1 year is 31, 3 years is 12.9, 5 is 21.23, which is not bad. The reason why this is up a lot is compared to all the other ETFs that I've showed you, the Microsoft and the Apple distribution was 6, 6 and 9. I was 6 and 7, 15, 15. It was this one, the iShares, the IYW. It was 18 and 18. So the commonality is that the more you have exposure into Microsoft and Apple and Google and Nvidia, these are high growth stocks. Also, they pay a dividend. 3, they do buybacks. So they pay a dividend, they do buybacks, and so it increased the ownership of you. It increase your ownership of the company when they buy back the shares of their company. So it's all a win-win. And then also by them reinvesting their money into the company is also growing fast. So it's all these different factors. 22%, 21% in Microsoft, and then everything else is blended. So if you're looking for a high growth ETF that you will put your money in and you want it to grow, I would say do not use this as a core fund. Use this as a satellite. It costs $204.74. If you use this as a tech play, use it as more so a satellite play, not a core play. Now, for me, just for me, listen, I'm trying to be a millionaire. Hopefully you're trying to be a millionaire. If you got 30 years, right, and you start off with $1,000, and if you were to choose VU or VTI as your core, and if you were to choose IYW, QQQQ, and let's just say maybe SCHG. It was one I wanted to put in, but I didn't put in. Another ETF is a semiconductor ETF called SMH. But you start off with $1,000, and the variables is you start with $1,000. You're going to contribute $500 per month, 30 years. You're going to receive an 18% rate of return. You can achieve 18% rate of return not from VU. VU will give you typically 10 to 12%. The 18% comes in at IYW and QQQQ and SCHG. QQQQM for sure produced at least like 18%. SCHG also produced like 18 to 25%. And then VU is a wild card. That's your stable ETF, right? If you were to start with $1,000 and you put $500 per month, getting that return, and you just trucking along, right? You would have hit millionaire. You would hit millionaire status by year 21. So if you start at age 30, you'll be a millionaire at 51. If you start at 35, you'll be a millionaire at 56. If you wait, so on and so on. But time is our friend. Time is compound interest. Time is wealth. Compound interest equals time. Time equals compound interest. So all in all, what I'm trying to tell you is start now. Start now. VU, IYW, QQQQ, SCHG, boom. Roth IRA, taxable account, do what you need to do. Lastly, to show you guys that I am not a imposter, I put my money where my mouth is, boom. SCHG, boom. VU, and the yellow shows that I actually bought some today, or it means that you bought some today or you received a dividend. Today I actually bought some food. That's why. SMH that I told you, the semiconductor ETF, boom, and then also QQQM. So the ETFs that I went through with you guys, here you go. Shows that I am, and then I have JetQ and I have Lam Research, but those are stocks. We're not gonna go through those, but just want to just show you guys that I put my money where my mouth is. I'm trying to invest into my Roth IRA so my Roth IRA can be millionaire status by the time I want to retire, or by the time I can tap into it. These growth funds are highly volatile. They go up, down a lot. They go up a lot. It is what it is. Just ride it out. Hope you guys enjoyed my video on how to invest, what stocks to invest into, and we're out. Peace.